Hello, everyone, and welcome to our installment of Meeting of Manager Minds. And following from our previous podcast, where we took a bit of a deep dive into fixed income, today we're taking a bit of a different angle. Obviously, hedge funds are a bit topical, and we decided to bring in a fixed income hedge fund manager. And with me today, I have Bruce Thistlewhite from Oakhaven Capital. Welcome, Bruce.
It's easy. Thanks for hosting us.
Yeah, no, awesome. Just tell us a bit about yourself. Who's Bruce? Who's Oakhaven? The inception, and how did you begin your career and all of that?
Sure. So I grew up in Pretoria, went down to Maritzburg, studied down in Maritzburg, and was fortunate enough to go over to England to do a bit of work. And at that point in time, they were doing the Euro exchange. And when I came back to South Africa, they needed somebody at Standard Bank to do the Euro clearings, changing all the currencies around. And my name happened to come up, so I started at Standard Bank.
Okay.
And I did that for a couple of years and then got into their treasury, the domestic treasury. By the time I left domestic treasury, I was the head and director of Standard Bank domestic treasury. And while I was there, I met Johan Roos, who was the director and head of interest rate trading. And I know exactly when I left Standard Bank because it was in the middle of the World Cup, Soccer World Cup. So it was June 2010.
Okay.
And we left, and a couple of years later, Johan and I got together and we started the Oakhaven Capital, the boutique management, just in fixed income because that's where we cut our teeth. And since 2013, we've been managing money, and so far we're pretty happy. Things have gone well. Does take a while to build a business, but we definitely have built quite a robust business now.
No, awesome. Pretty sure you had a lot of fish and chips while you were in the UK.
Yeah.
I can imagine.
Mashy peas.
Yes. So today we'll be just unpacking, some of the insights as to what goes into fixed income hedge funds. And as you know, as Alexforbes Investments, we always try to bring the best and the brightest minds to just pick their brains, get their insights, and whether you are investor, an advisor, a client looking for insights, you are in the perfect space, as Forbes is known for being the investment destination. So I'll just get started maybe with a couple of questions. How different is a fixed income hedge fund different to a normal fixed income fund? What is that differentiator?
Yeah, so I think in a long only fund you'll find that you get income funds. So CISA categorizes you as money market, short or variable term. So money market, most people are very aware of. It's very low duration, so it's really a cash plus instrument. Then you get your short term investors, which people can extend the duration. They can buy assets that are out to 5 or 7 years. And so you get a much better return than money markets. And then the last one on that list is the variable term, which is generally the bond funds. So in Oakhaven we have a short-term fund, and we also have a variable term long-only fund. We don't have a money market fund because we believe actually from an investor's perspective it's better to take your money and put it into an income fund, which is your short-term funds. You give up 24 hours, you've got to give 24 hours notice to withdraw your money, but your returns are going to be somewhere between 50 to 100 basis points better per annum. So that's why we don't have a money market fund. And then we also, as I mentioned, we have a variable term fund, which is more like your all-B returns. And I think the important thing here to understand about a variable term fund or an all-B fund is because, last year, for example, they did 24%, and people go, well, if bonds are yielding 12%, how do you do 24%? So the important thing about bonds is it's pretty mathematical. So the all-B has about 6.5 years duration. So what 6.5 years duration means is that for every 1% that bonds go up or down, you will make or lose 6.5%. So as an example, last year bonds went from 12% to 10%. So on average you get 11% yield for the year. But because they dropped 2%, you get 6.5 times 2. So you get another 13%. So you get that 11% plus 13%, and that's how a variable term delivered 24% last year. So it's a little bit different to equities, where you sort of know that if I buy something at 100 and I sell it at 110, or I sell it at 90, sorry, I make 10 Rand. You can see I'm a fixed income guy.
Yes, I see.
So the important thing about that is we trade inversely. We trade yields which act inversely to the price action.
Okay.
But that's exactly how, so there you can see you make 10 Rand, whereas with a bond fund, you actually there's a bit of duration that you've got to take into account, and what we call convexity, which is a big name just to mean that the closer you get to the front end of the curve, the less risk you're running.
Okay, no, that's actually quite an interesting one, point that you make there, especially on interest rates. Now, where do you think we are from an interest rate perspective? Are we towards the end, and what sort of risks, opportunities does that pose for a fixed income hedge fund manager?
Yeah. So we actually think being long here is quite right, even though we're going into an interest rate hiking cycle. And the thing is what happens in the market? The market projects what's going to take place. So the market at the moment already has 3 to 4 interest rate hikes built into it. So if I go buy, let's say, 5-year paper, I've already bought those 4 interest rate hikes. So if you believe the Reserve Bank's only going to hike once or twice, you're actually going to make 50 basis points on buying the paper now rather than waiting. So again, just to bear in mind that we're forward looking, we're looking at forward curves, we understand what's happening in the forward curves and how that's going to impact the pricing on the instruments that we buy and sell into the future.
Okay, and in terms, I mean, you've obviously been in the industry for a while. In terms of some certain war stories, it would be interesting to understand where you feel you get the most learnings. Is it in a bull market or a bear market? Where is the biggest opportunity set and learning experience there?
So we obviously operate the hedge fund, the fixed income hedge fund. So what we do there is we do take leverage, and that's obviously the main difference between a long fund and the hedge fund is taking some leverage. So for example, there we might have 2 times the amount of bonds than assets, cash that we actually have. So what we generally realize is we have a long trading bias. We like to be long. We have a good story about South Africa. Every now and again there might be a political shakeout that causes us to sell off. But we do have a long bias, and one of the war stories would probably be COVID. Unfortunately, during COVID, we'd just had a really good budget in February 2020, and then COVID came around, and we cut a lot of our risk that we were running. But unfortunately, it still meant that we lost some money in the following March, in the March of COVID. Even though we'd cut our risk. So the way that we manage risk is called value at risk, VAR, which basically means if I don't change my position, how much will I lose over 10 days? And we try and make sure that we do obviously change our positions. We manage through the loss cycles and through profit cycles. We have stop profits and stop losses. And so we will manage our risk accordingly. And from that perspective, it's sort of one of the things that Johan and I bring to the business is we've managed our books under VAR through banking regulation systems while we were still at Standard Bank, and so it's a methodology that we're quite comfortable with. So one of the things you'll find in a fixed income hedge fund is we don't really ever talk about leverage. We talk about the value at risk that we're running.
Okay. No, that's interesting, because also with hedge funds, you normally expect them to add a lot of value in market corrections. I would say you would have been a beneficiary of that market correction to the latter end of Q1. What is then the most crowded trade right now that you as hedge fund managers are currently facing?
So I think at the moment, what we have to guard against is we're very macro orientated. So we believe whatever the Fed does, and you can see it in equities and in fixed income, whatever the Fed does or whatever Donald Trump tweets is going to make a big difference to the outcome of your books at the moment. We very much can't control what Donald Trump's going to say, but we're very much macro driven. So we'll analyze the Fed, we'll look at what we believe they're going to do into the future and how that's going to impact our market. So at the moment, we've all gone from expecting rate cutting cycles to now expecting rate hiking cycles. We've got a new unknown, which is Kevin Walsh, who's now going to be the Fed chairman. And we have our own little scenarios around what's going to transpire with the new Fed chairman. But we think that at the moment the market is pretty flat. We don't think that there's people that are too bullish or too bearish. I think there's a lot of people waiting for the end of the war, which might be too late to put the risk on because things will drop quite quickly, and you'll be able to make money quite quickly from that perspective. But likewise, if Iran says we're not going to give up our stockpiles of uranium, this could drag on for a lot longer. So we think the market's pretty neutral here. We don't think that we overexposed, generally speaking. We're trading a little bit on the long side, and the reason we're trading a little bit on the long side at the moment is in South Africa, we think that the South African terms of trade, which is whether we are importing more or exporting more, is really advantageous to South Africa at the moment. The terms of trade are really in our favor, like they were in the mid-2000s, when South Africa, I remember mid-2006, 2007, employment, we were driving employment low. There was a really good feel-good factor around South Africa. I think we've got to that stage again. Notwithstanding the fact that oil's high, our terms of trade are still really, really good. So that's obviously based off the back of the PGM metals. And from that perspective, we're quite bullish South Africa.
Okay.
We think the revenues are going to overrun from a collection perspective. We think that the government is curtailing their expenses. They're making sure that they're not spending more than what's budgeted. And then on top of that, obviously the fact that we've moved to a 3% inflation regime is really helpful. I say it's really helpful. I do understand that we expect inflation to peak up just over 5% over the next 3 quarters, which is there's going to be headwinds, but those headwinds are priced into the market. As I've said, we've already got 3 or 4 interest rate hikes priced into the market. So those headwinds are more or less priced in. So we're pretty bullish at the moment.
And then in terms of constructing portfolios, so what's your starting point? Because obviously you didn't mention macros, having that macro lens. How do you then start off with day one, your portfolio? How does it look like? What are you putting in there? Are you starting off with the OB and then taking bets on and off, or how are you looking at that?
We try and deliver a cash plus return. So we actually don't reference the all-B at all.
Okay.
So from that perspective, when we look at it from a macro perspective, we're very much aware of, are we the least dirty shirt that Europe, America wants to invest in? So our main competitors in that environment are Turkey, Brazil, Mexico, Russia, India. So those are our main competitors. And when you look at it, Brazil's actually in a sweet spot at the moment. You could argue Mexico's in a sweet spot. Turkey's fallen off a bit at the moment. They got high inflation issues again. Russia's uninvestable at the moment because of sanctions. So from that perspective, we understand that there's a lot of demand. Now we know that foreigners probably own the least amount of nominal bonds they've ever owned in South Africa. So when we look at foreign ownership, we don't look at it as a collective whole, which is what gets reported, which includes inflation linkers. We look at what they hold because they don't generally hold inflation linkers. They really look at our nominal bonds. And, at the height in 2016-17, they were owning 50% of our nominal bonds, so half of our nominal bonds. That's down to 20%, 28%, 30%. So there's a lot of scope for foreigners to come back into South Africa. And that scope's going to improve as the credit agencies re-rate South Africa. We know that we've just been given another positive outlook, which generally means that within 6 months they're going to move us up, or they will then move us back to stable. So the 3 credit rating agencies, two of them have got us on positive. One of them's got us on neutral. But we expect that over the next 18 months we should move another notch up. And as soon as we start, that means we bottomed out. And because we bottomed out, it means that a lot more foreigners are going to take an interest in us. We're starting to get close to that investment grade again, which then opens up a whole new dynamic for South Africa from an investment perspective.
And I guess with hedge funds, there's a lot of high frequency trading involved in that whole process. Well, I guess what is maybe that one thesis that didn't necessarily play out the way you would have wanted to? Maybe it was a timing issue, or maybe just the markets turned. And conversely, what is the trade that actually really worked out for you, and you can say, you know what, that's the one I put up on my wall?
So we've been pretty fortunate over the last 3 to 4 years. There was Jafekra. We got wind of Jafekra when there was a first research note that came out about the fact that the South African Reserve Bank was sitting on 500 billion rands worth of $1 billion worth of excess reserves that could possibly be taken back by government and national treasury. So we were definitely long over that November. I think it was 2023, November 2023. We were able to get some good returns then. We got some really good returns over the Government of National Unity when that was formed. So that was really good. What wasn't good was after a really positive budget in 2020 with COVID, and of course now in 2026 we had a really good budget again. You'll remember the 2025 budget, we went through 3 scenarios, and eventually we got a really good budget, sort of version 3 of 2025. We were of the view we were going to get a good budget now in 2026. We got a really good budget, and then unfortunately on the 28th of February everything fell apart when Donald Trump went into Iran. So you know, we felt we had good positioning over those 2 scenarios, but COVID and Iran sort of spoiled it. But you know, we've managed to we got back both of those times, and I think that's the thing about hedge funds. There is going to be volatility.
Yes.
We are going to have volatility.
Yeah.
But you've got to trust the manager that they understand why they were running that position, and have they managed to actually exit that position or trade themselves out of that position.
And I guess being in that space, there's a lot of, you know, data points you collect, a lot of signals you look at, but what's that one signal that you can't ignore? Or maybe ask it differently, what's that one indicator that you look at, that you have to look at on a daily basis in order to enjoy your first cup of coffee?
Yeah, so there's an index called the iTrax, which is it's a European index for high yielding credit. So we follow the iTrax. You know, generally speaking, if the iTrax starts rallying, it's a risk-on environment. People will be looking to buy high yielding instruments, and if it's selling off, then you'll find that the opposite is true. So we do follow the iTrax quite closely. It's a really good indicator for us. And then of course, you know, I can't drum on enough that whatever the Fed does impacts our market, and as I've mentioned, whether it's equities or fixed income, it's a big player.
And what would you think allocators or clients misunderstand, or that myth around hedge fund fixed income?
So I think it's very important to understand the manager. So, you know, if you look at equity long short, for example, you understand that, you know, they're going long one bank, short another bank. And in fixed income, it's very similar. You'll get guys that might run a lot of risk directionally, or you might find guys who run a lot of risk on the curve. So when I say we're running risk on the curve, it's spread risk, where we might be long a 20-year, short a 10-year, or we might be long a bond and we might be short a derivative against it.
Yeah.
So from that perspective, in fixed income, there's very much driven by the personalities of the people that are managing the money. We sort of trade a little bit between directional and spread. We look for high conviction, and you know, we've got data points from 2013 now, and we can actually see that when we take a lot of risk, which means our value at risk goes up, our VAR goes up, we can see that our performance is better. So from our perspective, we can actually see that when we've got confidence in a trade, it's working out, and when we've got low confidence, it's generally it's not working that well. So we very much are confidence traders and taking real good value at risk.
And I mean, you mentioned value at risk. Obviously, as a hedge fund manager, you look for dislocations in the market, mispricings. What would you maybe feel or believe is the single most underrated risk currently?
I know a lot of people worry about credit. We worry about credit. I have a famous story to bore everybody, and the problem with credit is I can't just, when I'm in a theatre and the theatre's on fire, I can't just exit the theatre. What I got to do is I've got to convince somebody else to go into that theatre. So I've got to find somebody who will buy it. And it's not that credit is a problem. I just think that when you look at the returns, I can get just as good a returns investing in bank paper or government paper. So from that perspective, I'm pretty happy to say that I can give you the same type of returns with way less risk in the paper that I invest in. And it's not that we don't take credit. We've invested in bank AT1s, which is bank capital basically. When they were issuing them at Java plus 450 basis points over, we were quite happy to buy them. Now that they're issuing them at Zionia plus 210, 220, we actually would rather maybe go into inflation linkers. We got into inflation linkers 18 months ago when the real yield was over 5%.
Yeah.
It's a position that we've held for 18 months. Those real yields they're now under 4%. We've been able to get a good return out of that, and we don't trade inflation at the expense of nominal. So we understand that you can own nominals and inflation linkers. A lot of people go, well, why don't you have nominals? Why do you have inflation linkers? We go, well, we have nominals and inflation linkers, and there's a risk return relative value strategy behind both of those positions.
And I mean, on that topic of credit, you did mention that you cut your teeth during COVID as well. If spreads blow out tomorrow, what's the first thing you're doing?
So if spreads blow out tomorrow, the first thing we do is de-risk.
Okay.
You've got to de-risk. So cash is a position. We believe cash is a position. We're quite happy to hold cash. So we de-risk straight away because that's a risk-off move. And fundamentally, what takes place there is people sell everything that's liquid. South Africa is a very liquid market. So even though there could be a good story to be told about South Africa, we're very fortunate. We've got deep markets here because of pension funds that invest into government paper and that. But they'll sell South Africa first. Afterwards, they then try and get out of everything else that they can. So you've got to, the first cut is the best cut. Take your first loss quickly.
Yeah.
And then wait for a re-entry point.
Oh, okay. No, that's interesting. And being in that space, what would you be doing right now if you weren't in financial services?
If I wasn't in financial services, I'd probably be going over to America to watch some football, watch the World Cup. I think we stand, hopefully we'll do better. I did follow them in 1998. I followed them around France. I was hopeful that we'd do better than what we did do. I still remember playing against France and they were singing Isa'u, Isa'u, which means where are you, where are you? It was so bad. But no, it's quite weird. One of the things that did perk my interest was architecture. Maybe nice. I would have been an architect if I didn't go into banking. But yeah, when you leave varsity, when you leave school, you go, well, let's go do a BCom, and that was the rage. Seems like BSc is now the rage. Everybody does BScs, but
And I guess maybe closing off, what would be that one competitive edge that you would have over other similar types of asset managers?
So we are a boutique. We only do fixed income. I think when you look at it, both Johan and myself were first on the sell side, being at a bank. We're now on the buy side. So that does help us understand sort of how do corporates hedge themselves, how do pension funds hedge themselves. So from that perspective, we understand flows, where the flows come from. Demand and supply it's not just a thing about buying widgets. Demand and supply is a thing about buying and selling bonds. Buying meme stocks, for example, is demand and supply. So it's very important to understand that demand, that side of things. And then understanding, I think we all have our views of what the Reserve Bank should do or the monetary policy should do or what they shouldn't do. But I think it's important to understand what they will do and what they won't do. It's irrelevant what I think they should do. It's very important to understand what they are going to have to do. Tomorrow is an interest rate meeting. Every economist in South Africa at the moment's got 25 basis points penciled in. We think they'll do 25 basis points. And the main reason is we understand that this is a supply shock, not a demand shock. But I think, when you look at our governor, he's conservative. He doesn't want second round effects to take hold. So it's sort of an insurance policy. You pay your little bit now and you can reap the rewards later.
No, 100%. Thank you so much, Bruce. There you have it, everyone. With me, Bruce, giving us some insights into the fixed income landscape and the hedge fund and how they think about portfolios and the markets in general. And there's always, more where that came from. Stay tuned for our next installment of Meeting of Manager Minds, and thank you for joining.